Hey Nick, how are you?
I'm good and you?
Good, good.
Good. So, PLA, we've got another two questions to run through today. Bruno, I'll start with you. We've been dealing with companies and structures for investments when it comes to property investments. And last week we dealt with a little bit of what governs a company, how does it work. Today we're going to look at the other side of that is once you've established your company, once you're running this company, how do tax obligations work in respect of companies?
So how does a company get taxed? And is the tax rate actually preferential or is it a high tax rate? Now, to understand taxation in South Africa, we need to understand the concept of income tax. So we pay tax on all money that we earn. So as individuals, we pay tax even on our salaries. And as a company, you pay tax on the money that you receive, right? So this is a common principle. Everyone should understand basically that income results in tax being paid to SARS, right? Now, there's different types of income, and we need to look at different types of money coming into an account. But keeping it simple, a company makes money by charging clients for either a product that it's selling or a supply or supplying of a service, right? So now, what is the difference between a company being taxed and an individual being taxed, for example? Well, look, not much, because you can run a business in your personal name, and if you receive income, you'd be taxed at your income tax rate. A company similarly gets taxed at the income tax rate. So the difference really isn't on how they're taxed, but it's on the actual taxation rate. An individual doesn't work off a fixed tax rate, right? We work in brackets. So the lower the income of an individual, the lower the tax rate of the individual, which means the lower the tax. So when you speak about things like bracket creep and the tax brackets changing, all that really means is the tax rates change as your income increases. So just as a very like stupid example, let's say between 1,000 to 100,000 to 200,000, a person pays 20% versus 200,000 to 300,000, they pay 25%. So obviously the tax rates do work differently and they are quite broad and very specific because you pay lower tax rates up to a certain amount. And then on the next bracket, you still pay what you had paid on the previous tax bracket, but now you pay a higher percentage on the next bracket and the next bracket and the next bracket. And I can make the tax rates available to everyone in this video in the description. Right. Now, how do companies differ? A company has a flat tax rate of 27%. So that's pretty good because for an individual, 27% is actually relatively low, right? So if you're running a successful business and you're doing it in your name and you're potentially hitting above the 27% mark, it's a very good idea to consider potentially using a company to earn the income because you pay a fixed tax rate of 27%. And that is known as corporate income tax, right? But it doesn't end there. And that's the unfortunate thing with our tax regime in SARS, it never just ends, right? Now, unfortunately, so the company pays 27% on the income it receives. Now, what is income? Let me quickly explain it to you. So taxable income isn't just the money you receive, you are allowed to deduct certain expenses. So your operating expenses, or basically expenses during the course of your trade in order to generate that income, are deductible as long as they're not capital in nature. And we'll discuss that at another point. So let's say, for example, you receive 100,000 Rand and you want to deduct the cost of your rental office, of your employees, of your basically anything, even your utilities, the water that you pay or the electricity that you pay, you can deduct it from that gross income you receive. And once you start deducting that, the next step is you are allowed to deduct certain allowances. Now, again, we're not going to go into detail on this, but it's just good for you to know that from the income tax, you are often allowed to reduce your income tax or your taxable income by certain wear and tear allowances. So it's depreciation of your assets. You're basically reducing their value and you're reducing your income, you're paying less tax. Again, this is something that we need to explore in far, far more detail. Just something to remember, allowances are deductible and they reduce your taxable income to the point where you hit that line of taxable income. And that taxable income is then what you pay 27% on. So if you have very high expenses and your income matches your expenses, you typically pay no tax, right? If your expenses exceed your income, you'd be running at a loss. And that when SARS approves that loss, it's called an assessed loss. And this assessed loss gets carried from year to year up to a certain percentage. So that is how that initial corporate income tax rate works. However, this sits in the company. Now, the question always is, that's fine, but now what happens when I want to use the money? Do I just take it? And unfortunately, no, you don't just take it. And there's usually two ways that you as the owner of the company or director of the company would access this money. And this is especially so when it comes to small businesses. Now, the one way, and this is in big business and typically our businesses work, if the shareholder wants to receive some sort of benefit from his holding of the shares and actually being the owner of a company, he would declare, or she would want the company to declare dividends, right? So dividends is basically the payout the owner of the shares gets for the good performance of the company. And there's certain rules behind when dividends can be declared. Now, dividends tax is 20%, right? Now, again, we're not going to go into the maths behind it, but now remember, you've paid 27%, so that's gone. Now, the leftover gets taxed at 20%. So the effective rate is around 41. So that's quite high. So it takes 41% in taxes to basically get money in the pocket of the shareholder. So what people usually do in small businesses, and there's nothing wrong with that if they're genuinely employed or they work for the small business, is they simply draw a salary, right? And if they're actually doing the job and they can be considered an employee, they're allowed to draw a salary. So the money comes into the company and now they pay themselves a salary, they deduct it from the gross income. So the taxable income is lower. They pay the 27% on what's left over. And then in their personal names, they pay their tax rate on the income or the salary that they've received. So those are usually the two ways that corporate income tax works. And then the other is how a shareholder pulls money out, and it's either through dividends or through pulling out a salary. Either way, you're going to pay tax. So you kind of balance which one works out better. If you had a 45% tax rate as an example, probably doesn't make sense to pull a salary. Dividends lands up being cheaper. Right, so that's now the corporate income tax. Is there anything else? Remember, guys, we also have capital gains tax. So capital gains tax in a company is also taxed at the 27% mark. Whatever the gain is, one looks at 80% of the gain, and on that 80%, you would at the company is normally taxed at 27%. So it's quite high. Remember, as individuals, we only look at the 40% of the gain, and we get taxed on that 40%. So whatever our tax rate is, versus a company where you actually look at the full 80 and you get taxed 27% of the 80%. That makes sense. Is there anything else that we need to know about company taxation? So yes, there is. So in the following video, I'm going to discuss small business corporations and micro businesses, because there's special tax rules when it comes to them. So we'll deal with those later. Also remember, running a business, things like VAT might need to kick in. So we might need to have a conversation about whether you're a VAT business, how that works and how it works to sell your assets and that sort of thing. And remember, if you're a business, tax-wise, you also need to factor in that your employees are getting an income and they need to pay tax on that income. But according to our laws, it's not up to the employees alone to ensure that that tax gets paid. We have something that's called pay as you earn. And what that basically is, it's a function of the employer to deduct a certain estimated amount of tax from the employee's salary, pay it over to SARS, so that when the time comes for the employee to submit their assessment, as an example, SARS already has tax sitting there and waiting. And then when the employee submits the assessment, they either get some money back or they have to pay money in. And also, one last thing, please remember, if you run a business and you're drawing income and you're doing it by way of dividends or that sort of thing, please remember that you would have to pay tax, not through dividends, because the 20% is already paid. But with a lot of individuals that don't receive salaries and they're drawing income either through, as a sole proprietor, for example, they have drawings, please remember you become a provisional taxpayer. And as a provisional taxpayer, because you're running your own business, you also have certain payments that need to be made occasionally to SARS every 6 months, just to make sure that you make provision for whatever tax needs to be paid by the end of the financial year.
Thank you, Bruno.